Hello, in this video we're going to be talking about money. We're going to be looking at how money gets its value, how it's used, and various functions and roles that money plays. So what is money? Money actually has several different functions, which we're going to see in a few slides, but most of the time we think of it as a way of facilitating trading. So if I want to go buy a cup of coffee, I give them money. Even though I'm an economics professor, I don't have to trade the Starbucks barista an economics lesson, right, or something of value that I have. I could come to school, I can teach my class, I could get paid a salary, and then I could take that money and buy things from whichever stores I would like. Before money, people would have to barter. This is where you would trade goods and services for other goods and services. Bartering requires a double coincidence of wants. So I have to have something you want and you have to have something I want for us to be able to trade. And they have to be of comparable values. Now, in very small or simple economies, bartering is something that can work. Generally, there aren't a lot of different goods and services, and people need the same types of things. In more modern economies where we buy very large, expensive things, we purchase things over time, bartering just doesn't work very well. Imagine you wanted to purchase a house in Los Angeles, and this house is selling for $720,000. If we were in a barter system, you would have to have $720,000 worth of goods and services to trade the person selling the house. And it would have to be $720,000 of goods and services that person wanted. Today, instead, we use money. And because we also have a banking system, we can get loans. We don't have to have the value of all of that stuff up front. So money, whether it's coins, shells, paper, or other materials, it's going to make trading a lot easier. What kind of things can be used as money? Can anything be money? First, it needs to be acceptable to both parties. It also needs to be durable, something that's long-lasting. It's not just going to be destroyed in a short period of time. Something of standardized quality. So the quality is measurable and easy to tell. And something that is divisible, so that it can be used for larger or smaller purchases. So for instance, we could use jelly beans or ice cream cones. Let's see if these meet our conditions. Okay, so let's say we live in a society where everybody really likes sweets. Okay, so they like jelly beans, they like ice cream cones. So both of these could potentially be acceptable to both parties. What about durable? Jelly beans are fairly durable. They can last at least several days, several months, several years. Okay, so jelly beans would be durable. What about ice cream cones? Are ice cream cones durable? I would say probably not. One test of durability would be if you leave it in your pocket overnight, what's going to happen to it? Leave some jelly beans in your pocket, you find them the next day, they would still probably be usable. You leave an ice cream cone in your pocket till the next day, probably not going to be usable. What about standardized quality? Yeah, both of these could have standardized quality. There could be rules for how much cream and sugar you have to put in the ice cream or the size of the scoop. Jelly beans, you could make them a certain size or requirements for ingredients. Divisible, yeah, jelly beans are fairly divisible. They're small, so you could use them to make tiny purchases or large purchases. Ice cream cones could potentially be divisible. You could scoop off half of it possibly, so I'd say maybe for that one. So jelly beans are probably a better commodity or thing that we could use for money than ice cream cones, but both of these are not great. As you can see, there aren't any societies right now that use either jelly beans or ice cream cones as their currency. So commodity money. This is money where the value comes from the item that it is made from. Some examples are gold coins, shells, and tobacco. These items have value outside of their use of currency, but as long as they're acceptable to both parties, they're durable, they're divisible, they can work. Okay, so gold is useful for many things. Shells can be used for many things. Tobacco is used for several different things. So commodity money, the value comes from the item it's made from. We can also have representative money. So maybe we want to use gold, but we don't want to carry the gold around with us. So instead we print paper money that is backed by gold. So representative money is backed by a commodity. Presumably the banking system or the government has a store of that item equal to the value of the currency in the economy. The United States used to be on the gold standard, so all U.S. currency used to be backed by gold. You could take a $100 bill, turn it into the bank, and they'd have to give you $100 worth of gold. Currently, though, in the United States, we have what's called fiat money. This is money that's not backed by any commodities, but rather backed by confidence in the government. So the paper that we use for currency doesn't have any value in and of itself. It just has value because we trust the U.S. government and their ability to guarantee its value. It's guaranteed by the government's ability to keep the value stable, meaning inflation is not high, we don't have hyperinflation, and they keep the economy moving in the right direction. Fiat money is a lot more flexible than commodity money or representative money because it doesn't rely on a physical product or a physical thing of value to exist. So especially when the governments are trying to actively manage the economy and the money supply, it's very difficult to do so when you require a certain value or quantity of some sort of commodity. So fiat money, the value is not affected by world commodity levels. For instance, if our currency was still backed by gold and all of a sudden we discover we need gold for all of our vehicles to run, the value of gold is going to shoot way up. The value of our currency is going to go way up. Likewise, if somebody discovers a huge store of gold somewhere, the value of the currency could go down significantly. And so governments that are trying to manage their money supply, manage their economy, manage their money, they're going to be able to do that much better with fiat money than they are commodity or representative money. Fiat money is a token currency, so the face value is greater than the intrinsic value of the actual material that's used. If we're just looking at the value of the paper it's printed on, it's much less than whatever the printed value on the currency is. Money has several functions. The first, and the one that we generally think of, is money as a medium of exchange, where we're using money to buy and sell goods and services. Next, money is a unit of account. It's a standard way to value business activities. Money is a store of value. It's something that we can use to hold wealth for future use. Money can be a standard of deferred payment. It facilitates purchases over a long time period. Money is a liquid asset, so it can be easily used and broken up to make purchases. If you ever hear about a liquidity crisis or problems with liquidity, it has to do with turning things that are valuable or other assets into cash. For instance, let's say you own a house, but you don't have any money in your banking account. If you would like to go buy a gallon of milk, you can't simply take a shingle off of your roof, take it to the grocery store and trade it for a gallon of milk. You need cash. You need something that's liquid. So money is a liquid asset because it can be easily used to purchase other things. For example, if you needed to buy groceries today, would it be better to have $200 in cash or a watch worth $200? Most likely the grocery store won't accept the watch as payment, so cash would be better. Even if you could sell that watch, it's going to take some time to turn that into money to be able to use it for something else. So there's different definitions of money, or different categories that money is put into. The first one is called M1. This includes all currency, paper and coins. It includes electronic checking account deposits and traveler's checks. M2 is a broader definition of money. This includes all of the stuff in M1, plus other accounts that can be easily liquidated. Things such as saving deposits, including money market deposit accounts, small denominated time deposits, money market mutual funds, and anything that could be easily transferred into a checking account or turned into cash or electronic currency. M2 is 4 times larger than M1. What things aren't counted as money? Credit cards and other physical assets. So your credit card is not money. It's actually a revolving loan from the bank. Physical asset, even though you have things that are of value, your house, your watch, those things are not counted in the money supply. Institutions offering checkable deposits, such as commercial banks, savings and loans association, mutual savings banks, and credit unions, they will take all of your deposits, whether it's cash or electronic deposits, and they will hang on to that for you. We're going to see in a later video that banks then take this money, they use it to make loans, and that increases the money supply. So M1, this is a visual representation. M2 is this larger circle. M1 is the smaller circle on the inside. So M1 is coins, paper currency, checking account deposits, and traveler's checks. M2 includes all of that plus savings account, money markets, CDs, other time deposits. M1 is the most liquid form of money. You can spend it almost immediately. M2, savings accounts or CDs, you may have a limited number of transfers per year. So you may not be able to spend all of it immediately. Maybe your savings account has a limit of, 4 transfers out per month. So depending on how you plan and what information you know early enough, it may work out well to transfer that money to your checking account to be able to spend it. This is a chart showing U.S. paper currency. This is the volume of currency in circulation today. Mostly we've got ones and hundreds and 20s. There's other bills in circulation, so $2 bills, $5 bills, $10, and $50. But most currency that's used in the United States today is actually electronic, in the form of electronic checking or savings accounts. There's not a lot of cash, actual physical currency, to back up all of that digital currency. So why is money valuable? First of all, it's valuable because of acceptability. Money is valuable because people will take it as payment for goods and services. Money is valuable because it's legal tender, meaning legally you can use it to pay off any debts that are owed. It's valuable because of relative scarcity. I can't just print up my own money at my printer at home because I want more. It's limited, regulated, processed by the government. Money has value because of its purchasing power. Purchasing power is what you can get with your money. So if I have a $5 bill, how much is this worth? What is its purchasing power? Well, today I could go buy a cup of coffee, but in the early 1900s, this was a full day's wages. So purchasing power gives it value. And prices are going to affect purchasing power. So if a coffee is $5, I'm not going to have as much purchasing power as if coffee was $1. Hyperinflation renders money unacceptable. So governments try really hard to keep inflation rates low and stable. Governments try to control the money supply to stabilize its purchasing power. They want the money supply to increase as the economy grows, and they want to make sure that the money supply is potentially decreasing if there's a lot of inflation. This requires appropriate fiscal policy. So the government, the federal government, does things to manage the money supply. And also management of the money supply through monetary policy, through the Federal Reserve Bank. We're going to talk about more of those in their own chapters. Now it's time for a triad example. Which of the following are currently used as money? Explain your reasoning using the functions of money. Gold, a Van Gogh painting, and a dime. So go back to those 4 functions of money and see if it fits all of them. So medium of exchange, store of value, unit of account, standard of deferred payment. Now pause the video, go through this, and then come back to see the answers. So gold is currently not money. It's not used as a medium of exchange, although it could be. It doesn't really serve as a unit of account. It can be a store of value and a standard of deferred payment, though, because it is durable and it does hold its value over time. Van Gogh painting is not money. It can serve as a store of value. It's highly illiquid, but could eventually be converted to money. So it's not really a medium of exchange or unit of account. And a dime. A dime is money. It serves all of these functions and it is perfectly liquid.